Bismillahirrahmanirrahim. Assalamu alaikum. Good afternoon, everybody. Your host of show today is Reemal Qureshi from the Financial Academy. I would like to invite you to a new series of webinars which we have created for you, which is called FinExpert Hub. This program is where we bring in the professionals from all around the world for your professional development and growth through an online platform every month on a new subject of interest. Today's event delivery partner is Emeritus, and we would like to thank them for their contribution. This program is sponsored by the Financial Academy. The role of Financial Academy is to provide high-level educational services to the professionals to improve their skills and their talent and innovations in the field of financial sector. Of course, this is as a driven sector for the Saudi Vision 2030. Our visitor today is Professor Andrew McDonald. Let me tell you something about Dr. Andrew. Professor Andrew McDonald is a management consultant and executive education professor over 30 years with board C-level experience. He has worked globally in the banking and financial sectors for nearly about 40 years. During this time, Professor Andrew has been a chairman of Contango Funds Management. He's been a visiting professor of the universities, where he has taught ultra-high net wealth management investment strategies programs. He's been a visitor professor at Columbia Business School, where he has taught global banking programs. His experience also involves head of sales development in National Australia Bank and director of business development in Ernst & Young. He is going to be presenting a very interesting topic today, which is impact investment. With a few housekeeping tips for the success of this event, we will be opening a chat box for your questions. So we will take them at the end of the seminar for your questions to be answered. There are going to be two barcodes which are going to flash during your presentation. One of them is for the polls, and the second is then for your satisfaction survey. The event is going to be 90 minutes, so please keep up. Professor Andrew is presenting an interesting topic, impact investment. Without further ado, I would like to introduce Professor Andrew McDonald.
Thank you, Reem, for that very kind introduction and opening remarks. Good afternoon to everyone. Good evening from me here in Australia. It's wonderful to be with you, and I'm super excited and honoured to be here to spend the next 90 minutes talking about an incredibly important and emerging topic, impact investing. So what I'll do is just share my screen so that we can get underway and set the scene about what we're going to be covering today. So really looking forward to engaging with you and your questions towards the end. But what I'll take you through is this wonderful field of impact investing, which is really gained momentum as a topic of interest, but also as a thematic in investing, particularly over the last few years. So what we need to do is spend a little bit of time understanding what the impact investment landscape looks like. There is a lot of misinformation out there when it comes to impact investment. So it's very important that we understand what it actually is, what it's trying to achieve, and also the landscape that underpins it. We'll then move on to a broad discussion of the 4 characteristics of impact investing, before then looking into a really interesting topic, which is around the roles and motivations of asset owners. So what is it that leads to a pension fund or a sovereign fund or a retail investor, for that matter, wanting to actually invest in impact investing? So what's behind their motivations and interests? And then, of course, we need to discuss the key operating principles for impact investment and look a little bit about the performance of different funds, but also at the same time have a look at the reporting that underpins this as well. So that's the broad 4 topics that we'll be going through. But let me just frame it up by saying that impact investing is not particularly new. Impact investing has been around for a very, very, very long time in terms of investors being conscious of the investment decisions that they're making. And there are organizations throughout history that have invested for the benefit of a broader community. Others have invested with excluding certain investment categories or organizations because it doesn't fit with their social purpose. And that's been time immemorial, where there's been societies that have been very focused on environmental or social outcomes. And you see that with a lot of Indigenous societies, with First Nations people around the world, and their way of doing this is very much aligned to this landscape. But in the modern day world in which we live in, impact investing is gaining a lot of traction and a lot of interest, not least of which because it's now starting to address what was previously a bit of a myth, which was that if you're investing for impact, then you're going to be doing so with an expectation of lower financial returns. And increasingly what we're seeing is that that's not the case, that it is possible to come out with that dual purpose, that dual outcome. So we'll look at that in some detail. So the impact investment landscape to begin with. Now, like a lot of things in this space, there is no one universally accepted definition of impact investing that everybody says, that's it, that's what we accept, that's what everybody needs to refer to. But there is a couple of things that come out of actually thinking about the definition itself. So this one here from Yova, impact investments are investments made with the intention to generate positive, measurable, social and environmental impact. So very important that we focus on positive and measurable, and the fact that it's looking at social and environmental impact. And secondly, alongside a financial return. So it has a dual purpose. The one is to make a measurable positive impact, and the other one is still to give the investor a financial return. Now, in terms of how do we take that into the world of investing, well, this comes from James Gorman at Morgan Stanley. His view is that to galvanize the necessary capital to have real impact, sustainable investing can't be limited to investors willing to accept unattractive returns in order to create social good. Getting to scale requires investment products that seek attractive returns while benefiting society. This is the philosophy behind our investing with Impact Platform. So he's making very clear to all of us that in order to do this at scale, we're going to be able to have to create, in his words, not mine, investment products that actually generate positive financial returns at the same time that they're doing social good or creating social good. So for those of you who are more left brain than right and like to see things visually, basically this sums it up for us. The dual objectives of impact investing: seek investment outperformance, so looking for alpha, and seeks measurable positive impact. So they're the two things. So if you keep them in mind all the way through, then that, if you keep coming back to those two dual objectives, then that will go a long way to helping you really understand what this is all about. But just unpacking it a little bit further and starting to move into the world of understanding the difference between impact investing and other types of investing. If you look at the middle here in the slide, you'll see here that sometimes impact investing is mixed up with philanthropy. A lot of ultra high net worth individuals, for example, through their family offices, target philanthropy as part of their agenda and the values that they hold. But generally speaking, philanthropy is really focused on impact return. They're not necessarily expecting a financial return from philanthropy. Quite often, philanthropy actually involves giving money away that you'll never see again, or there's not an expectation of a financial return. Sometimes it's concessionary, where you will accept a below market rate for an impact return. But impact investing is you target a competitive return and an impact return. So there's that duality of approach again. Integrational socially responsible investing is an integration of ESG, so environmental, social, and governance factors into an investment process. Now, SRI, or socially responsible investing, and ESG are used interchangeably with impact investing, but they're not actually the same thing. And then alignment is about negative screening, optimizing for desired outcomes. And that's basically where you have fund managers, for example, who screen out organizations or indeed industries because they don't want to have a desired exposure. So things like weapons manufacture, tobacco manufacturers, for example, are quite often excluded in some funds and portfolios because that's not the desired exposures that they want. I'm sure there are funds that still chase returns from those industries, but for those ones that have a negative screening component to the way in which they're creating their funds, they'll exclude some sectors or some industries. So some of the myths that are associated with impact investing, as I said, impact investing is philanthropy. It's not. However, the two, in some ways, can fit like hand in glove. Somebody can be interested in philanthropy at the same time as having an interest in impact investing, in fact, become an impact investor, and at the same time be investing in philanthropy. So that you don't have to do one or the other, you can be doing both. Impact investing is small scale. It's historically been very focused on very specific projects that are community-based. However, as we've seen the size and reach of impact funds growing, we're now starting to see larger scale opportunities that are addressing larger challenges like CO2 emissions, as an example, and I'll come to that as we move through. High impact returns imply low impact. Higher financial returns do not need to negatively affect the quality of the impact investment. In fact, as it says here, a company may solve the problem much faster if it is highly profitable and able to scale quickly with impactful products. Now, that's one of the things that's held up as being a key cornerstone of impact investing, is that it leads to greater innovation, because it's pushing industries and organizations to adapt and transition into different ways of manufacturing, different ways of producing, of running logistical supply chains, of different ways of engaging with their customer bases or the society at large. So one of the things about achieving scale is the link back to innovation. And in fact, that's been discussed a lot in some societies like Japan, which I'll talk about a little bit later on as well. Impact investing is only in poor countries. Not true at all. The impact investing can actually be aligned to an initiative in poor countries, but it tries to address things at a much more global scale or regional scale, depending on the aim of the organization or the fund itself. And then finally, impact investing can only be done in private markets. That's not true as well. Increasingly, public markets are making opportunities to have impact investing as part of your overall portfolio through access to an ETF, or indeed directly through a fund of some kind. But there are also other instruments and investment products as well, which we'll discuss as well. So they're just a few of the myths, just to sort of clarify what it is and what it isn't. But again, in terms of the evolution of this, what we've seen is this whole change in the evolution of the impact economy, where if you look from early modern, the sort of 1450 to 1700 era, that's really where we're looking at the whole era of subsistence and coming into the moving from the Middle Ages into the more modern period. Mercantile era was really about trade. That's where we're starting to trade through the 16th to 18th centuries. Then, of course, the Industrial Revolution in the 1760s started this whole focus on material goods and production, and then output as a result of the late 19th century, where we started to get efficiencies around and innovations around the things like production techniques and so on, increasing GDP. But now impact is the next focus around quality of life. And as I mentioned before, this is whilst we're talking about it today, the Japanese government in 2016 produced a paper that argued that Industry 4.0, that a lot of organizations and countries are talking about, was actually no longer relevant. That as early as 2016, they were focused on Society 5.0. And Society 5.0 is about living in a hyper-connected world through advancements in the likes of AI, ML, IoT, Internet of Things, and all those sorts of things coming together, digitization, improving the quality of life for all of us. So they've been talking about this for the greater part of 7 years. and they were a front runner to a lot of what we're about to discuss now, including this. What is interesting is that increasingly the United Nations focus on sustainable development goals, 17 of them that you can see on the screen in front of us, has now been linked directly to the reporting standards and also the investment process that many of the impact investors are adhering to. So basically what it's saying is, as funds, as sovereign wealth funds, as family offices are looking at this landscape of opportunity, they're referring to these sustainable development goals as part of their investment process, and then are reporting on the impact that those investments have had and how they've contributed to these sustainable development goals. Now, the Sustainable Development Goals were published in 2015 with an aim to eliminate social and environmental problems by 2030. Each of the Sustainable Development Goals has specific targets and indicators, which I won't go into today because it's it would take too long to go through all of those. But essentially, a little bit of what they've been trying to achieve has been disrupted by the pandemic, and some of the progress has been set back, but others have been advanced. So, for example, health-related initiatives as a result of looking for new vaccines and those sorts of things have actually accelerated, but other things have sort of moved into the background a little bit. But what it's basically saying to us is that this focus is going to continue on for some period of time. Now, the spectrum of responsible investing, I mentioned SRI and ESG before. So SRI is basically looking to screen investments based on ethical criteria. So what we're trying to do is to, if an investor has a particular set of values or has a particular set of principles around where they want their money to be invested or not invested, so they can be positively or negatively screened, they'll use this process to ensure that companies are included or excluded. So as I said before, it could be a thematic or an industry or something of that nature. ESG, or environmental, societal, and governance, evaluates a company's environmental, social, and governance exposure, quantifies a risk that is not captured on financial statements, and primary objective is to generate sustainable financial returns. So in other words, they're looking for investors are looking for companies that espouse those values and can demonstrate their focus on those values. And that can be things like governance and social, for example, could be a good place to work, a healthy workplace where the employee experience is heavily focused on. The last one here is impact, is directly about influence. It's about how you invest and how you have a direct, meaningful impact on a particular societal or environmental concern or target or theme. And for things like lowering carbon emissions, reducing opportunity gaps, equality, access to clean drinking water, all of these sorts of things can come with specific targets. But again, just to re-emphasize, just to make it very, very clear again, a dual objective of generating positive returns whilst also having impact. So in terms of the spectrum and how that looks, you can see here across the board the approach from finance first to impact first across the top. Then you have everything from the traditional approach to philanthropy, where impact is everything, and the traditional is about financial returns. The finance goals accept competitive risk-adjusted financial returns, and you can see all the way here, access full loss of capital. So in a philanthropic endeavor, you're accepting of the fact that you may never see that capital again. In fact, that's probably what you're doing. You're gifting or you're donating some of your funds, or you're bequeathing it through an estate or something like that. Impact goals range from avoid harm and mitigate risks, mitigate or reduce negative outcomes for the people and the planet, benefit stakeholders, generate positive outcomes for people or the planet, and then the last one is contribute to solutions, generate positive change, for otherwise undeserved people or the planet. And some of the intentions you can see down the bottom there. So in terms of the asset class spectrum, you can see that you've got everything from listed equities across these different industries, or you've got also corporates and high yields through green and social bonds. And green and social bonds are becoming more and more prevalent, and we're seeing a lot more issuance of those in recent years. And then you have less liquid investments like private equity, private debt, and then real assets, or sometimes known in the industry as hard assets, but all real assets, so infrastructure, real estate, and natural resources. So things that are much more, you can put your hands on, you can touch and feel them. So, as I said, interchangeably, sometimes it's not known as hard assets in the industry, otherwise known as real assets as well. So what is an impact investment? So if you look at it in terms of the discussion here, impact investments could theoretically arise in any asset class or geography. That's important to note down as well. However, they mostly fall into the following categories. So private equity, so investment into companies that generate overall positive impact, societal, government, or environmental, sorry. Generally, investments have been directed to emerging markets and have often in the early or angel or venture capital stage. So quite often you'll see the private equity investing in a startup or an enterprise that is much more related to a social initiative in a particular geography. But also we're seeing it directed increasingly to more mature companies in more mature markets, where the sheer scale of those organizations allow them to be able to have a more meaningful impact on a global scale. So they may be domiciled, for example, in Saudi Arabia, but they may be able to have a really meaningful impact on society in a country in Africa, like Chad or something like that. Property and infrastructure, investment into renewable energy, green buildings, disability housing, and social infrastructure. This whole thing around green buildings is an interesting one, and this is gaining a lot of currency at the moment, where looking at the energy efficiency of buildings and then actually monitoring those buildings to see the overall impact on the footprint that they have, but also seeing the level of emissions from those buildings as well. So increasingly, we're finding buildings that are being constructed with this from funding from funds that are interested in impact investing, but at the same time, what they're able to do is fund the development of a building or buildings that are actually having a positive impact, not a negative impact on their local environment. And then, of course, you have debt finance, fixed income, social impact bonds, and you have a whole range of things there. But for the purposes of today, I'd probably mostly focus on the second one, microfinance, where we're seeing a number of initiatives where in emerging markets in particular, where you have startups that are maybe social in nature, where you have a village that produces a particular product or a particular a food product or clothing product, for example, but they need some finance to be able to grow and distribute and manufacture at more scale. And increasingly, we're seeing projects that are linked to smaller villages or communities, but also green bonds that I mentioned before, which are similar to traditional sovereign or corporate fixed income securities, but they're specifically linked to initiatives around climate or the environment, so that hence the name green. Sizing the market is an interesting one. If you Google this or you put it into ChatGPT or something else, you'll find all sorts of numbers around just how big this market is. But the Global Impact Investing Network, or GIIN, is probably the one that I would rely on the most. They are estimating that it's somewhere around 1.1 trillion US dollars at the moment. If you have a look at that, the overwhelming representation of organizations participating in impact investing are fund managers, so around 63%. And then you also have the likes of foundations, and then you go through diversified financial institutions, family offices, and you can see there that other accounts for 11%. And it's important to note that other also includes sovereign wealth funds, or SWFs. Now, SWFs, as I'll show you just a moment or two, they're starting to emerge as a really important investor in this space. So, we'll come to that now. Now, in terms of organisational representation, by and large, it's a Northern Hemisphere phenomenon to this point. Most of it is in US and Canada and Europe. So most headquarters in terms of AUM, so assets under management, associated with impact investment are either in the US, Canada, or in the Western, Northern, Southern Europe. A lot of it is also in the UK. So if you break down Europe a little bit further. You also have here a regional commitment of measured impact funds. You can see here you have quite a significant amount, 57% global funds. Reem, did you need me for something? Reem? No? Okay. Sorry, I just thought I was going to be asked a question there. Okay. So 57% global funds you can see here, and global funds, of course, the large share of that is US. Then you have emerging markets, 31%, and you can see the breakdown of the emerging markets there, and then 12% into developing markets. So that's something just to note as well. We are very heavily based in the US as well. However, this is the point I was making. This relates to sovereign wealth funds. And you can see here that there's been an increasing amount of interest over the last few years. The spike in 2021 was a result of sovereign wealth funds investing directly into pharmaceutical companies who were working on various vaccines. So that's why there's a spike in the number of deals, but also in the dollar value attributed to those deals as well. And now you can see that in 2022, as we come out of the pandemic, the numbers are still quite significantly higher than they were in 2020. And that's a bit of a theme that's going to emerge as sovereign wealth funds change their investment process and look for alpha in different areas. In case you're interested in terms of which sovereign wealth funds are looking into this space, you can see that the largest deal value is from GIC, which is a sovereign wealth fund based in Singapore. Mubadala, who I recently did some work with out of Abu Dhabi. You also got Abu Dhabi Investment Authority, Qatar Investment Authority, and then Temasek Holdings is out of Singapore as well. And then you've got Public Investment Fund from Saudi Arabia. So you can see here that there's quite an active participation from sovereign wealth funds in the Middle East, which is really pleasing to see. Sovereign wealth funds, in many ways, were slower into this space, not so much ESG necessarily, but into this space because of the very nature and the way in which their investment guidelines were constructed, because it was very clear around chasing expected returns and didn't allow necessarily for impact. But increasingly, they're changing their frames of reference and their investment processes to accommodate this as well. So that's why I just wanted to share some data with you with respect to sovereign wealth funds, because it's something that we're seeing as a really emerging trend, particularly out of the Middle East. Okay, so now that we've defined what an impact investing is, we've had a look at the landscape. We've also considered what it isn't, and we're very focused on what that dual purpose of financial returns and also doing good in society or making a positive impact. We're very clear around what that is. We also know the distinction between SRI and ESG, and we've had a look at the landscape. Now what we need to start to look into is the characteristics, the 4 characteristics of impact investing. So the core characteristics, as I talked about just a moment ago, come from GIN, from Global Impact Investing Network. So the core characteristics of impact investing complement GIN's definition of impact investing. So the 4 fundamental tenets, which have been refined in collaboration with leading impact investors around the world, provide further definition of baseline expectations for impact investing. So what's really important about this piece is that it wasn't dreamed up by some think tank or wasn't exclusively constructed by one organization like the United Nations. This has come about as a result of significant consultation across the industry, across sovereign wealth funds, fund managers, non-for-profits, family offices, various government agencies and entities, non-for-profits as well. So all sorts of input before they then came out with the core characteristics. So the 4 characteristics, which we'll unpack a little bit further on the next slide, intentionality to contribute to positive social and environmental impact. So in other words, there has to be an intent. So your intent is to make a positive and social and environmental impact. So first of all, the intention must be there. It's not going to happen by accident. We need to know that it's going to happen intentionally. Use evidence and impact data in investment design. So as you design the product or the portfolio or the fund, you need to be able to evidence and actually provide reporting on the fact that, that you are actually having a meaningful impact. Manage impact performance. So you need to be able to report back on what level of impact you're having. So it could be through things like your ability to measure CO2, for example, and we'll talk about that as an example in a little while. And then contribute to the growth of impact investing. This is a really important one, because what it's saying to us is that what we're wanting to do is to create a bigger ecosystem where more and more players or stakeholders, if you like, are coming into the landscape of impact investing so that we can grow the overall size and scale so that we can have more of a meaningful impact on society at large. So when you break that down in further detail, just remember that intentionality is exactly that. It's about having an intentional desire to make measurable social and environmental benefit. So you're actually looking to solve problems and also address opportunities. So, and this is what is really different, is that you're doing it with the intent to make a positive contribution. Investments cannot be designed, number 2, on hunches. We need evidence and data to drive the intelligent investment design that will be useful in contributing to social and environmental benefits. So I've got, I think, 3 case studies for you this afternoon, and I'll show you this exact 1 and 2 coming through an investment process by one of the leading players, leading fund managers in this industry. And I'll show you a very live example of how they bring this into the investment landscape. Manage impact performance, I mentioned just before, and then contribute to the growth of the industry, as I was saying before, where you're starting to share investment practices, you're starting to share ideas and thematics from conventions, you're producing results and sharing them so that everybody can see the societal, the social and environmental impact that you're having as well. This slide here actually comes from the impact assessment process of Regnan, who are a large fund manager who play specifically in this space. And you can see here very clearly intentionality. The impact assessment consists of 5 tests that any candidate for investment has to pass. And you can see here intentionality has been inserted very, very early into that process. How central is the solution to the company's strategy and mission? So what they're looking for is, it's not something that the company is just talking about as a small bullet point on the bottom of their annual presentation. That's actually very clear that this is part of the overall strategy and mission of this organization or company, that they have the intent to actually make a positive impact on society as well. So let me give you an example of how all of this comes out to play in the real world. So taking it away from academic definitions and some stats, let's have a look at Baillie Gifford, based in Edinburgh. I'm from Scotland myself. I'm from the Isle of Skye, but I spend quite a lot of time in Edinburgh. And one of my very close friends, who you'll probably see on a future webinar, George Baburis, who is an absolute legend in the funds management industry and asset management industry. He'll probably be talking to you in a later webinar. He spends a lot of time in Edinburgh, and he and I were sharing ideas around Baillie Gifford over the weekend. So let me talk to you about Baillie Gifford's process. And this brings alive a lot of what we've just talked about. So we're taking this into the very practical world. So this is their actual process now. So the first thing they do is, what are they looking for? Okay, so they're looking for growth companies and also positive impact. So they're looking very clearly for those organizations that are going to produce a positive financial return. In their words, growth companies. But that must be the intersection of the two. Idea generation. So for them, they've cut it down into 4 key areas: social inclusion and education, environment and resource needs, healthcare and quality of life, and base of the pyramid. Base of the pyramid is a term that was coined a number of years ago that basically refers to the poorest members of society who don't have an opportunity to contribute beyond living to just create enough money to subside, to live to the very basic level of life. They're very much called at the base of the pyramid because they're the lowest social economic class that we have. And this is a focus on how do we lift or redistribute wealth. And I'll show you a chart on that that George shared with me earlier. Fundamental company research, asking 8 questions, which I'll show you in a moment or two. And they have a 3-factor model looking at impact analysis. Then from there, they move into how do they construct their portfolios. And they probably have around 20 to 50 companies in those portfolios. And then from there, they look at monitoring and engagement. So the 8 questions that they ask are, what change is the company driving? What is the scale and growth of the opportunity, and how might it evolve? And of course, in terms of how might it evolve, we're looking for it to evolve progressively and grow. What is required to unlock the opportunity, and how quickly can the company capitalize on it? So if it's an early stage company, how quickly can it capitalize the opportunities? If it's something that's going to take 15 or 20 years, is that something we should be considering, or is it possible this company may achieve it in 2 or 5 years? What is the competitive edge, and how might it develop? What attributes of the culture, governance, and management attitude will support or detract from the company's ability to capitalize on the opportunity? So this is getting right into the organizational culture. What are the financial characteristics today, and how may they evolve? What might the company look like, and what might its valuation be in 5 to 10 years? So very much focused on the valuation and potential exit. And what will it take to be an outlier? So what's it going to be that's going to actually really highlight this organization as being something really different? The 3-factor analysis looks at these following critical 3 critical components. So product, ESG, business practices, and you can see it broken down. So what they're looking at from low to high, 3 being high, is to look at how the product impacts, what intent they actually have, and what is their existing business practices. And of course, if they're rating or ranking highly in all 3 of those factors, then they're going to meet the criteria that Baillie Gifford are looking for. But if they don't, then depending on which of the factors are lower, they'll assess it and base it on merit. Now, this is a difficult screen for you to see, but I just wanted to highlight for you that this is an actual company that they've taken through this process. And the company, some of you may know, John Deere, that make tractors, typically green ones. And you can see what they've done is they've gone through the questioning process. Up the top on the right-hand side here, you can see that impact analysis that they've done from product, from impact, and also from business practices. You can see here, John Deere scored 2 for product impact, 2 for intent, and then 1.5 for business practices, which largely related to ESG. Now, what's super important about showing you this screen is not just the impact analysis that they've done. If you look down the bottom here, you can see that there is the United Nations Sustainable Development Goals being linked to this analysis right at the beginning. So you can see them starting to talk about the relevant targets and the relevant products. And in this particular case, they've highlighted 4 of the Sustainable Development Goals as outlined by the UN. So you're seeing that UN methodology really coming into the investment process of an organization that's heavily focused in this space. You can also see here that in terms of looking at that whole space around company impact, what they've done is they've looked at the input. So they've looked at the R&D expenditure and the number of employees. They've looked at what is it that John Deere actually do. And for this purpose, they've really focused on what's called precision agriculture technologies. For those of you who are unsure, that precision agriculture is basically using things like GIS, GPS data to position tractors and other farm and agricultural equipment so they can be much more precise at doing things like putting in fertilizer into the ground, planting, also spraying for pests, so that you can be much more direct and precise in where you're spraying, where you're planting, and so on, so that you can have a minimal impact on the environment around you, but also potentially driving higher yields, by being more precise about where you're actually spraying and putting fertilizer and so on. You can see here that they talk about output. In 2021, Deere's agricultural products were engaged in over 315 million acres around the world. And then the outcomes, precision technologies reduce inputs such as agrochemicals and fuel and increase yield. So there's the other benefit. So I talked about yields, but they're also talking about a reduction in the need for fuel and agrochemicals. And then you can see here, they've given an example of Deere's Precision See and Spray Select system can reduce herbicide usage by 77%, right? So there's a positive contribution there. So then, of course, they're reporting, and the annual report that they provide some significant details into the fund's impact across all of the holdings. And what they do then is they relate that back to a look at a portfolio level impact, and they're starting to measure it and list those companies that exist within the portfolios that fall into the various categories here. So 87 million metric tons of carbon dioxide. And you can see that that's attributable to the likes of Ørsted, who are a renewable energy company, I think from memory, in Norway, wind farms. 1.4 billion people. So through the likes of Alibaba, HDFC and others, you can see here that they've been much more access to finance. And then 1.5 million patients provided treatment and disease management solutions. And you can see here, they've listed the companies again. So really important to note the link between what we talked about earlier, which was duality of approach, but also companies, specific companies that are then linked to specific sustainable development goals, and then that's reported on in the portfolios as well. So much so that at a portfolio level, what they then go on to do is to line up which of the sustainable development goals overall the portfolio addresses. And in this case, 16 of the 17, the only one that was an outlier in this particular case was peace, justice, and strong institutions. But otherwise, their portfolio has gone to address 16 of the 17 goals. So let me just pause for. Okay, so we've got a poll or two coming up in a moment or two. So just have your mobile phones ready so you can have a look at the QR code, and then we'll build it from there. So the first poll question for today is, which of the following generations is most likely to participate in impact investing? Is it baby boomers, who are people who are born between 1946 and 64, millennials, people born between 1981 and 1996, or Gen X individuals, or people who are born between 1965 excuse me, and 1980. So there's a QR code on the screen. If you just want to scan the code, that should take you over to Slido, where you can put your result in, and in a moment or two we'll have a look at the results. Okay, so I can see that there's 12 results so far. So we'll keep it open for just maybe another 15, 20 seconds. See how we go. Sort of 14 responses. Thank you. Thank you to those of you who are responding. Okay, so it looks like we are going to stay around there. Are we able to share the results now? Okay, so the results, 82% of you chose millennials, 11% of you chose Gen X, and then 5% of you chose baby boomers. So overwhelmingly you chose millennials, and you're right. So those of you who chose millennials are currently the most active impact investors. However, for those of you who chose Gen X, they're probably the fastest growing of the generations who are taking an interest in this, and even Gen Z, the current generation. So we're seeing a lot of movement in this space. Millennials at the moment, definitely, but Gen X and then increasingly Gen Z as well. So well done to those of you who responded. So what are the roles and motivations we're looking at? Well, it's needless to say, it's a very, very, very disrupted world with a lot going on. I do a lot of teaching for innovation in my executive education programs, and quite often I'll start with a slide like this to just talk about just the sheer amount of change that is going on in the world, not only positive, but a lot of negative change as well, where organizations, governments, individuals are having to respond to unprecedented change and challenges at scale and speed with the advent of new technology as well. So there are a limitless number of social and environmental challenges, which means that there's a huge amount of opportunity for asset owners to be motivated to invest in this space. But like most things, some people have an interest in one thing or a few things more than others. You know, for example, someone may be incredibly interested about access to education, whilst others will be more interested in access to clean drinking water, or somebody may be interested in both. But it can vary quite significantly. But it's not just about disruption. It's also about things like, so there is social awareness, ESG risks and opportunities. So what organizations are looking at is, asset owners are looking at is, you know, what are the risks and opportunities in the ESG space? And are we at risk of being exposed to companies that exhibit bad practices in ESG? So that's a driver. So you're seeing this negative screening saying, well, we're not going to participate over here because increasingly our unit holders or our investors are not going to be pleased with us if we're investing in companies that are polluting the planet. That's going to reflect badly on us, and then our investors are going to be upset. You also have political and regulatory pressure. So you have a lot of governments and societies, you know, for example, here in Australia, there's a lot of regulatory pressure. There's a lot of government pressure to shut down coal-fired power stations. So for electricity, so you're moving to gas, but there's the coal industry in Australia is enormous. So for example, our state of Queensland, I think it was just yesterday, reported a $9 billion royalty dividend that came from the coal industry. So it's a very hard, to break that history. So particularly where the coal industry employs thousands of people in the eastern seaboard of Australia, so sort of north of Sydney into Queensland. So very difficult to move from that. But the $9 billion that was generated, the government has said that they're going to put that into renewable energy projects, so the state becomes less reliant on coal-fired power stations and more reliant on renewable energy like solar and wind. And then, of course, you've got mega trends around population, education, equality, diversity, and technology, many of which we've already talked about in terms of the Sustainable Development Goals of United Nations. Now, very pleasingly, as part of getting ready for today, I took the opportunity to spend some time talking with George Bravouris, who I told you will probably be taking a future webinar for you. And George is on Bloomberg and CNBC every day, so look out for his webinar. But George and I were talking, and we're talking about one of the other things that he sees in impact investing, because he's heavily involved in this sector, was this piece around the disparity of wealth. And this goes back to what I was talking about earlier about Baillie Gifford's analysis, where they looked at a bottom of the pyramid or base of the pyramid. And you can see this is what they're talking about. The base of the pyramid is here, where it shows that 55% of the world's population live off of less than 10,000 US dollars. Sorry, they have a net wealth of less than US $10,000. As you can see here, that the numbers are extraordinary compared to the top of the pyramid, where you can see here greater than US $1 million, and that's 1.1%. So that's an example of base of the pyramid. So that can quite often be a motivation as well. You also, according to Fidelity, they have categorized it in this way, as quite often organizations do. You have those people who are purposely looking at for impact, so the impact seekers. You've got expression seekers, so they want to make a statement to reward or signal disapproval with corporate behavior. So they may be someone who's invested in a particular company and they pull out of that because they want to make a statement that that's not acceptable, we won't invest in that anymore. Alignment seekers, so they're wanting to align their values with a company that's not conflicting those beliefs. And then there's security seekers who focus on societal changes, on how societal changes could affect their portfolio and want to invest to get solid returns as well. If you look at this slide, comes from UBS, sorry, and you can see that according to their analysis, when you look at those 17 factors that Sustainable Development Goals that the United Nations are focused on, their investors, so UBS's investors, are heavily concentrating on pollution and waste, climate change, and water. So what that means is that data then enables UBS to say, okay, if that's what our investors are really looking for, that's what they're really caring about, then we need to create products, we need to create a thematic that sits around that. And then Schroders, what is your preferred approach to implementing sustainable investments? And you can see here that, and this is where it gets a little bit murky. You can see here that for some people, it is about ESG. For some, it's about positive screening. So let's make sure the company positively contributes to ESG outcomes. Then you've got impact investing. Then you've got active company engagement, where you're actively involved in a long-term view of taking a long-term view of the company. Thematic investing is what I was talking about before, where you have a theme like climate change. And then negative screening is where you're actively excluding organizations from your portfolio based on the screening that you have in place that they're making a negative contribution as well. In terms of still focusing on this piece around role and motivations, what would encourage you to invest more in sustainable investments? More quantitative evidence about the financial considerations of investing sustainably. Now, that's fair to say that this is a big topic in impact investing, which is how to quantify the returns, not only in terms of the societal impact, but what are the returns actually like in terms of the financial returns in terms of impact investing. And unfortunately, when you go looking for this, you'll find quite a significant amount of the data is talking about ESG, not impact, or it's talking about SRI, not impact. So unfortunately, it gets a little bit blurred here as well. Other things that would encourage is new investment opportunities addressing energy transition. So there's a particular thematic. More clarity around the different sustainable investment options available to me. So, what is that landscape that we considered earlier in the webinar? What does that look like? And then there's others as well. Reasons institutions are not engaged in sustainable and impact investing. The number one there is mission is solely addressed via programmatic or philanthropic activity. So they're already engaged in a particular allocation into an activity around philanthropy, and therefore they're not going to attribute any more into impact investing. So they already believe that that's being sorted out through their investment process as well. Perceived negative impact on financial performance. And this is one of the things that the impact investing community or industry has had to work very hard at, is to demonstrate that it doesn't have an impact on financial performance. In actual fact, it can have a very positive impact, but it's still an ongoing debate as well. Other reasons to not be involved, and this is more to do with, so I've been looking there at the landscape of more institutional investors now coming to the richest families, so looking more at family offices, and this comes from UBS's data. Happy with the current approach. In other words, they're getting returns that they're happy with, and they're not particularly focused on changing. Maximize returns and philanthropy approach. So they're very focused on the maximization of returns and keeping the two separate. So I want maximum returns, and I'll attribute some funds to philanthropy, but I won't tie the two together as well. Also from UBS, talking about the family offices, however, when you start to link it back to the ESG, the 17 ESG factors from, the 17 Sustainable Development Goals from United Nations, you can see here that for UBS, it's very much around education, healthcare, climate change, and then economic development, and then into other categories as well. So education and health really standing out there strongly. Then you go into someone like PIMCO, who of course is one of the largest asset management companies in the world, mostly known for their what they do investing in fixed income, particularly in bonds. You can see here that they've very clearly focused their attention on climate change and ESG bonds from the narrative that you can see on the screen. So what they're basically saying is their motivation is to focus on those. And you can see here the examples that they're using is net zero, portfolio emissions alignment with the Paris Agreement, deforestation, commitment, traceability and disclosure on forest risks. The third one's interesting, nutrition. So even though they're focused, they very clearly talk about being focused on climate change and ESG, it doesn't mean they won't look at other areas. So, in this case, nutrition has come up, but when you go over the page, you then start to see a discussion of methane, and then also national oil companies, and that piece is around enhancing climate disclosure and strategy. So what I wanted to just demonstrate through a couple of slides there is very, very clear indication from large-scale institutional investors around where it is that they're going to focus their efforts when it comes to impact investing. So some of them are trying to create portfolios that address all 17 of the criteria or factors that the United Nations have put forward. Others are focusing very much in certain areas for certain funds. Doesn't mean that across 50 different funds they don't address all the criteria, but it can be that in a particular portfolio or particular fund they're only addressing some of them. Now this is much more for individual investors. This is an ultra high net worth example. So what I wanted to demonstrate to you is that whilst this can be largely discussed in terms of institutional investors, it also does impact on the way in which individuals, or in this case, ultra high net worth families invest. And very much like any other investment process, when you sit down with a private banker or a wealth manager, they'll take you through a process of obviously profiling you, understanding what your goals are, your risk allocation. So, wanting to understand your views on risk in terms of, do you want to preserve your lifestyle? Do you want to preserve capital? Are you looking for liquidity? What is it that you're looking for? But then also starting to think about your need for cash flow versus your need for just capital preservation, and then starting to look at what are the products that we may be able to think about, and how does that fit in with and align with your values, and what it is that you're seeking to do. And what they'll then do is create or construct a portfolio with impact so that you have a broad diversity across your asset allocation strategy, so that you're not concentrated in one area or another. So we all know diversification is the key. The majority of impact investors look for a market rate return. So they do look for those return, and some align with sustainable development goals as well. So you can see that coming through as well. In terms of talking about how their performance is going relative to expectations, you can see here that financial expectations as well as impact expectations are largely in line with what they're looking for. So it's in line. It's not, it's not blazing a trail or giving you, huge amounts of higher returns, but it's in line with expectations. This is an example of what I was talking about before in terms of trying to get the data. This is a valuation of the MSCI ESG index. And you can see here, it is very much talking about ESG, but you can see here that it's slight ESG leaders are slightly outperforming. And if you look at it in another graph, you can see this is another one, S&P 500 ESG. You can see that the outperformance has been around 2.2% since launch. But again, it's talking about ESG. It's not talking purely about impact. So that brings us to the second of our polls, the second and last poll for today, is the themes with the most invested capital. Which of the following themes has the most invested capital? So there's the QR code, and the question will come up for you. So your four choices: resource efficiency and climate change, social and environmental equity, health and wellness, or education. So interesting watching Slido on this one. It's moving quite a bit, so there's quite a bit of difference of opinion on this one. So 10 respondents so far, so thank you to those of you who have responded. Keep it going for another minute or so. Much more even this time, so we've got quite a lot of you spread in your thoughts around this one. So the results here are still coming in. Very good, keep going. So it's quite evenly spread with a couple of them. There's a little bit of a change coming in late now, but largely it's a race between two now. Okay, so we might hold there and let's just see. All right, let's have a look at the results here. So the answer, 41% of you said social or environmental equity, and only 18% of you said resource efficiency. So you can see here, resource efficiency and climate change is number one. So that's where impact themes with the most invested capital. So most of it is flowing in to this theme around climate change and the resource efficiency at this point in time. And that's a survey from 2022. So I try to get it as up to date as I possibly can. So just a case study for you, just to see how a thematic is taking into a framework for investors. If you have a look here from UBS, you can see that this is a climate framework. So picking up on the climate being number one there, you can see that what they're trying to do here is to have a balanced approach where they channel capital towards what they call a lower carbon future. So they're looking at climate mitigation, So lowering exposures to climate risk, to carbon risks, looking at portfolio transition, aligning portfolios to your chosen climate glide path, and then portfolio adaptation, increasing investment exposures to climate-related innovation and solutions. So what they then do is have a look at equity solutions, fixed income solutions, and alternatives. They then provide a description of each of those, and then they have a look at the benchmarks that are available. And you can see here there's quite a broad section that is available to them. And then they categorize it in terms of mitigation, adaptation, or transition, and where it's likely and what impact it's having in each of those, depending on what they're trying to do. And the way in which they then measure that is to then look at it from a mitigation, adaptation, and transition perspective. And you can see here on the left, they're talking about things like e-leaders, companies that manage to significantly reduce the risk of negative impact. And then you've got CO2 intensity, climate risk, climate solutions. So companies are involved in renewable energy, climate solutions, and then green to brown ratio. So looking at things in terms of relative weight of green revenue versus brown revenues. So in other words, you know, those that are those revenues that have been generated have a positive or a negative or a neutral impact on the planet versus those that are actually, you know, maybe toxic emissions or something like that. But that's generating revenue for the company. And then self-decarbonisation and alignment 2DS scenario, so then 2-degree scenario, so then looking at the way in which the carbon footprint is transitioning and how you're having a positive impact. So you can see there that what UBS is doing is they'll go out and they'll do things like run a survey, get the data, put a process together around a thematic, and then start offering it to their clients through a specific investment process. So we've got about 15 to 20 minutes left. So let me quickly run through this piece around the key operating principles for impact management. So very important that we turn to this, and in many ways, I should have mentioned this earlier, but we get there at the end of the day. So investment managers need to demonstrate their ESG commitment, process and policies. So they need to show that responsible investment is part of their overall process. They need to be aligned to specific organizations, but they also, very importantly, need to be signatories to the Principles for Responsible Investment, or PRI. Now, this last piece around being a signatory, you can see that there's been a huge growth in terms of the number of signatories, as well as the number of asset owners in this space. So you can see since inception, just the sheer number of signatories and asset owners that have come into this space. So the 6 principles around PRI are voluntary and aspirational. So it's basically for helping to incorporate ESG issues into the way in which you practice your investment strategies. That's also being developed by investors for investors. As well. And so it's basically about ensuring that they align the investor with the broader objectives of society. So what are the 6 principles? So the 6 principles are: we will incorporate ESG issues into investment analysis and decision-making processes. We will be active owners and incorporate ESG issues into our ownership policies and practices. So the first one's investment analysis. The second one is active owners. The third one, we will seek appropriate disclosure on ESG issues by the entities in which we invest. So that comes back to that part about the companies that they're going to invest in. They are wanting to look very closely at their ESG reporting. Or we will promote acceptance and implementation of the principles within the industry. And that goes back to what we were talking about in terms of the 4 principles that we looked at earlier from Jin, and talking about promoting the industry more broadly. We will work together to enhance our effectiveness in implementing of the principles. So this is about building out a community of practice. And then we will each report on our activities and progress towards the principles. So there's this transparency around reporting as well. So why invest responsibly? So materiality, recognition in the financial industry and in academia that ESG factors can affect risk and return. Market demand, demand from beneficiaries and clients for greater transparency in how their money is invested. And then regulation. guidance from regulators that considering ESG factors is part of investors' duties and their clients and beneficiaries as well. And then you can see here, we've talked about ESG on the way through as well. You can also see from this slide that basically what's underpinning all of this is a process that talks about that, again, coming back to intent, that there is a strategic intent around the way in which you're establishing your contribution and structuring your contribution to this space, portfolio management in terms of how you're monitoring performance and the process, impact at exit. So that's an important part of this as well, is that if you are exiting, that you can actually measure the impact on exit, but also ensuring that what you're doing is leaving a sustained impact, and then independent verification. So there's the public disclosure as well. And you can see that the operating principles starting to permeate, and I just took out these two. This is from Cofidis and also BlackRock, and you can see that they're articulating operating principles for impact management and producing these documents that all of you can just go and download like I did from the web. So they're very much putting these together, organizing themselves around the operating principles, and then disclosing it for everyone to access. One of the reasons that they're doing this, and one of the reasons that there's such transparency in this space, is a thing called greenwashing. And greenwashing is a real concern in the industry, where you have organizations that are so-called greenwashing to make themselves look like they are having a positive impact, or that at the very least, they're not having a negative impact, and that they're putting themselves up as a company that is clean and green and is open for this type of investment, when actually they're not. And it's become a real problem, and you'll see headlines about greenwashing everywhere you go. So there's usually three types that we see here in funds management. First one is direct fund greenwashing risk, making false claims about the extent ESG is considered in investment decisions. In other words, the fund manager is overstating how important it is. Indirect, inadvertently making false claims about ESG outcomes based on third-party ratings or company disclosure. That is not accurate. So they're making false claims about what's actually happening. And then company greenwashing risk, holdings that make false claims about sustainability outcome or inflate sustainability benefits or products. And that's the one that we see quite a lot of. And of course, a few years ago, Volkswagen was caught up in this when they were found out to have much higher emissions from their diesel engines than what they were reporting on. It became a huge scandal for VW. So you can see here that if you go on into this more further, you can see that there's a lot of things that then start to look at what is it, who is it, how much, the contribution, and so on. And there's different measures of impact that become important as well. You can see that PIMCO, going back to the example I talked about before, in terms of the operating principles that they have, this is from their one of their reports. And you can see here that what they're very clearly doing is talking about avoided emissions, and then they've broken it down even further, avoided emissions per $1 US million invested. And then they're breaking it down into 74,619 cubic tons of carbon dioxide. You can see here that they then break it down into, well, that's come from these various areas, including passenger vehicles being taken off the road. But then some of the organizations, this comes from Mercer, will then also do that piece, but then report it back in terms of relating it back to the SDG factors that were put out by the United Nations. What I wanted to finish on is just take you into a portfolio so you can actually see this and how it actually manifests itself in an actual portfolio from Morgan Stanley. So if you have a look at here, what you can see is that this is a portfolio that is looking at impact summary. And you can see here, over here on the left-hand side, it's talking about alignment. And what they're saying here is that 7 of the 9 impact objectives have either equal to or exceed the benchmark. However, it's also acknowledging that 6 of 7 issues of concern have been raised because there is an exposure, in this case, to alcohol, carbon, underground, gambling, tobacco, bottom 5% of performers or oil and gas industry in this case. So what they're saying is, well, there's issues of concern, but you've got broadly objectives have been met, but 85% of your portfolio has been invested. They then break it down into, okay, 7 of your 9 objectives have been met. Which specific impact solutions or sustainable corporate practices has that been attributed to? And what's the portfolio performance relative to the benchmark? They then break that down even further by actually identifying those companies in your portfolio that address these particular issues, the impact solutions or sustainable corporate practices. So they're actually giving them a green tick, if you like, but then also aggregate exposure to issues of concern. And they're highlighting those issues of concern in your portfolio reporting and actually highlighting which of the funds or managed accounts are giving you that negative exposure or giving you that concern. And you can see here, they list the funds and they talk about, what it specifically it is. So this a really good example of the detailed complexity of reporting that's going into this space as well. So we've covered a lot of ground in a little under 2 hours. So we've talked about the impact investing landscape, the 4 characteristics of impact investing, the roles and motivations of asset owners, and then the key operating principles. So as I said, we've covered a lot of ground. It's a big topic, lots for you to think about and reflect upon, but I'm happy to answer any questions if there are any. So Reem, over to you.
First of all, thank you very, very much, Dr. Andrew, for educating us on things that actually, a few of them are very new, like zero carbon emissions that you mentioned. I've received a couple of questions, interesting ones, because I think it will add a lot of value for myself. What is the main reason behind the rise of impact investing?
Yeah, as I went through the motivations and of why impact investing has become so prevalent, it's a fantastic question, and it's a webinar on its own. So thank you for asking the question. But it's genuinely, the motivations are very, very different. But it's fair to say that a lot of it is being driven from a global movement to recognizing that a lot of the problems that we face, or the greatest challenge we face as a human society, can only be solved at scale globally. So things like zero carbon emissions, access to clean drinking water, climate change, all of these sorts of things require a global response, can't be done at a country or regional response.
Perfect, thank you. There's another question here. How do impact investment perform financially?
Yeah, and that was, I wish I could give you a very black and white answer to this one, but as I was trying to demonstrate to you, they are in line with market or slightly outperform, but it doesn't mean to say that a particular fund may significantly underperform whilst another one will significantly outperform. But broadly speaking, they are in line with market.
Okay, so are investors sacrificing a return by investing in impact investing? That's a tricky one, by the way.
Yeah, it depends on the individual. So for example, the answer to that is no, not necessarily, but it depends on the traditional things associated with investing in terms of your risk profile, the length of time that you're going to invest for, your other investments, what other asset classes you have an exposure to, and so on. So it just depends on the individuals, but the answer to it is generally speaking no.
Okay, so you mentioned some of the social issues in the country going on that could impact investing. How large is the dent that social issues could make on investing?
Well, and this is where the point that was made in one of the opening slides from James Gorman from as Morgan Stanley was talking about, he's talking about that the only way that we're going to address some of these major issues at scale is to have more and more funds pour into impact investing. And then you can start to make real meaningful change, not only just because of the sheer dollar value, but also by heightening the awareness that sits around this area as well, and actually giving a lot of companies that are, say, operating in this space access to capital earlier so that they can grow faster to meet some of these challenges.
Okay. Another question, is impact investing available to rental investors?
Yes, it is. So you can get access to ETFs, to some managed funds and so on, through most of the big investment managers, and increasingly, like Baillie Gifford, there's opportunities with specialists in this area as well. But yeah, there's lots of opportunities for retail investors.
Right. So based on your experiences and the backgrounds that you hold in the financial and global sector for more than 40 years, and you knowing the position of Saudi Arabia where it currently stands, what is your recommendations or your advices that you could give to our financial professionals in this sector?
Yeah, so I've had the pleasure and the honor of working in Saudi Arabia since 2017. In fact, I'll be in Saudi Arabia in about 3 weeks' time, working with one of your government agencies again. So I've been working on parts of the 2030 for a number of years. I think Saudi Arabia could actually probably own this space. A lot of the initial momentum has come out of the United States, but I think Saudi Arabia has absolutely, particularly through PIF, but also the maturity that's being shown in your funds management issue. I think Saudi Arabia is primed to deploy capital in a really meaningful way to make impact. And if you look at things like the line over the Red Sea, and if you look at some of the initiatives around renewable energy, Saudi Arabia is already leading, by the way, and one of my other courses in innovation, Saudi Arabia is already leading the way in innovation and digital transformation. So I think it's primed to lead the way in impact investing as well. Absolutely.
I was amazed to see the plans for the line and the cube that they have, they have programmed through. And it was amazing to see how Saudi Arabia is actually moving in direction, which is incredibly to be, worth quite a process. And thank you very, very much for this.
Yeah, pleasure. Thank you.
Thank you very much for Professor Andrew McDonald for coming up and spending extremely valuable time with us, educating and informing us. And have a great day. Thank you.
Thank you, everyone.
All right. Bye-bye.